Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We are here to try to help educate you about your retirement in the area of finances. What to do with your money in terms of investing, retirement planning, tax management, those types of things that we think are important to kind of enhance the financial side of your retirement. And so we do that by answering questions. You can send those questions in now. We're live here in Silicon Valley. Ask Tom at talkmoneywithtom.com. You can send them in on the email address there, or you can put them in the chat if you want to here on YouTube itself. And of course, we have a channel here that is full of videos and all kinds of educational content. You can go see that. You can hit the subscribe button if you'd like to subscribe, and then obviously hit the little bell button if you want to get notified when we're putting out new content. We feel like there's kind of a lack of information in this area, how to handle the investment side is pretty well, developed. A lot of people do that, but, a lot of the retirement planning, Social Security maximization, there's a lot of things that, that can be, answered here that we have on our channel that you might find interesting. So, and then lastly, of course, the best way to get customized answers to your questions is to just set an appointment with us so we can hear your specific issues. So you can go to our website, hit the book appointment button, and choose a 30-minute time just to meet with us, and we'll be happy to answer your questions in that environment also, as far as that goes. So I want to thank everybody for coming today. I'm really excited about this. I do like to start off every show here with a summary of what happened in the market for the week, because a big piece of retirement is trying to figure out, how to keep your money growing, especially at a higher rate than inflation, if possible, especially more recently. So let's look at what's been going on here in the market this week. So this chart goes back for a while, really goes back to middle of 2018. You can see the pandemic drop, that big cliff there. And the market's still doing quite well. 2022, we came down, inflation got high, they had to raise rates a lot. And if you look, actually, since that lower point in 2022, which is just up over my shoulder, you can see what's happened this week. That little kind of downward motion this week. Most of that came actually yesterday. The market was down almost 1.9% yesterday on the S&P 500. It was the last day of the month. It's up today. Where are we at today? Where this is live.
0.68%.
0.68%. Okay, so there's a lot that went on this week. This is actually a huge week. I have seen a lot of volatility in this week. This is the big tech earnings week, right? And if you look across the board, there's a lot of stocks that got sold off some, but in terms of who beat their expectations and who didn't, Apple, Microsoft, Amazon, Google, Alphabet, otherwise known as Alphabet, all did well, in my opinion, looking at how they did in Google's fantastic. They had a 35% increase in their earnings versus this quarter versus the same quarter last year. The analyst expectations for the overall S&P 500 was an expected growth of 4.3%, which is actually fairly low. And a company comes out with a 35% increase in their earnings. We should have seen a really big move.
Yeah.
And actually, we should have seen some big moves all week long. We also got the PCE report that came out, right? So this is the big number where everybody's talking about what's going on with inflation and the Federal Reserve and whether they're going to cut rates or not. Well, they came out. Basically it's the same. It's been the same core PCE inflation rate, right around 2.6, 2.7%. Since May of this year.
Yeah, month over month was slightly high, and so some people had some concerns on that for core. But it still has to do with housing. It seems like if you take out housing, from core, you're at 0.2, which is kind of in line with what the Fed is looking for.
Yeah, I think honestly, even with the pieces that are in there, if the Fed is just going to finally decide to stay in a range instead of going for 2%. They've had a couple times where they're trying to hit 2 and they got down to 1.5, and they don't like that either. And I think 2 is kind of close to the edge. It's an arbitrary number that they picked years and years ago, and so why not have a range 2 to 3%? And honestly, kind of, if you look at what they're doing, that may be what they're trying to do without saying that they're trying to do that. If that's true, then we're already there.
Yeah.
And then the other report that we got this week, which I thought was really good, and again, most of the stuff that I saw this week was good. Markets down for the week.
I think it's just election jitters.
Yes.
People don't know where the market or the elections are going, so people are getting kind of defensive in a sense.
That's exactly right, which is normal. So this is a chart going back to the 1950s as a gross domestic product. And you can see a few times where it dipped down, right? What, like the big 2008 downturn, those gray bars are recessions, right? 2020, there's a sharp little dip there because of the pandemic. But they just came out and said the third quarter annualized out at a 2.8% gross domestic product growth. And so this is like the total revenue of the country, so to speak. And it's got a nice overall pattern. And since the bottom of 2020, we've had a really big run.
Yeah, and people are saying that the 2.8%, even though it was below expectations of 3, it was largely because there's a large trade deficit, meaning that consumers were buying more, and so that people were importing more.
Yeah.
And so also with the port or strike, people were importing a little bit extra heavily because of they were trying to get ahead of the.
Yes, yeah, as we head into the Christmas season and such too. So yeah, I think it's kind of interesting. The economy's become political, which is kind of weird in a way, but you can see why. But the numbers are the numbers. It's either good or bad at any point in time. The market's either good or bad. But I think very importantly that, the stock market is a leading indicator. So right now, when we look at gross domestic product, it's just going pretty much straight up, right?
Mm-hmm.
It looks pretty good. But it doesn't mean it won't turn down at some point in the future. It does mean that it has been good, since 2020. I mean, there's no doubt about that. That's a fact. And so, the economy is good right now. The stock market is also still going up for the most part, even though it's down this week. The pattern of the market is up. The primary trend is up. And to me, what that's saying is that, the market is expecting in the next 3 to 18 months for the gross domestic product to still be good also.
Yeah, October was a relatively flat month for the market.
Yeah, exactly. Even though we did come down this week, we had come up in previous weeks. And so it did become a negative month, which we haven't had a negative month since April. But again, in yesterday's video, when I was talking about it, I was like, it's not so much a surprise that it dropped 1.9%. It's more of a surprise to me that it has run up as much as it has during this kind of 60-day period prior to the election, because my experience has been negative, right, on a presidential election during that period of time. Talked about that last week, showing kind of what happened in the last presidential election and how had 2 big drops, September and October. Again, I think the reason that this is one a little bit better is because their rate cut that happened September 18th of a 0.5 point, which was seen as a surprise at that time. And so altogether, though, when you look at inflation here, when they talk about a soft landing, we're doing it. This is it. I mean, you've got inflation that's very close to the target, right? Mm-hmm. Yet you still have the economy still growing, right? You can get stagflation, right, where the economy just doesn't grow very much, and it just kind of sits there. You can get recessions, where the economy falls apart because rates went up too high and stayed up too long. And the soft landing or even no landing scenario is what is happening right now. And so it's kind of incredible as far as that goes. Now, today we got the jobs report. Oh, sorry, one more thing I'll talk about with earnings real quickly. So this is a chart that's very fascinating. It comes from Charles Schwab, and basically the blue line shows on a percentage basis how many of the S&P 500 companies beat the analyst expectations. Mm-hmm. So first of all, it's 70 to 80%, even in the high 80s there for a little while. So analysts are pretty far off. They're a very pessimistic group as a whole in terms of earnings. But you see what we're doing right now. We're kind of in that 80% range. It's been really strong, and earnings continue to do well. So, for example, if you have a 4.3% expected earnings growth for the S&P 500 across all the analysts, and the S&P does 8.8 or whatever it does, right, and it beats expectations, the market will generally build that in. Now, we're not seeing that right now, And because I think there is an artificial suppression coming from the election, but to me, that just means that the pop after the election could be even stronger. There'll be a reason to buy, right? Okay, we can buy because the election's over. We know who's in Congress. We know who's in White House. And we have had good earnings, and let's get in there and buy these companies that we like and such too. And so most of the companies that are doing really well actually on earnings basis are the mid cap and large cap companies. If you look at the small cap companies as a group, their earnings have actually dropped 3 years in a row. And so that's one of the reasons why you're seeing so much volatility in the small cap arena. Someday that might change, and there'll be some opportunity there. But the second line in here is this gold line, and that's just how many beat on revenues. And if you look closely, not as many companies are beating on revenues. There's kind of a downward trend there, and that could be because, first of all, the analysts maybe are getting better at doing the revenue projections. But revenue is a little bit easier to see, right? By the time you get to earnings, you've gone through all kinds of accounting mechanisms for cost of goods sold and and depreciation. And so that's probably much harder to get right, whereas revenues might be a little bit easier. But that doesn't mean revenues are coming down. They're not. They've been coming up. Consumer spending is really, the key driver here. But you're going to, again, we talked about the mega forces that are coming into the market here. Here's one of the big ones, and I think a lot of people are missing this. Stock buybacks are something company will announce, and they'll use some of their revenues and excess, monies to buy back their own stock. It's a financial engineering move designed to kind of shrink up the number of shares that are outstanding. Mm-hmm. And so if you still have the same demand, theoretically, the price could come up, right? Yep. And that increases shareholder value. There's blackout periods during the earnings period where they're not allowed to, buy back. November, though, the projection is there'll be about an average of $6 billion a day of corporate buybacks going on. And again, these are the bigger and medium-sized companies that are doing that also. The smaller companies obviously don't always have that much, in terms of excess cash flow like an Apple would or something like that as far as that goes. So, so that I think it's a big driver. November is a good month anyway. Post-election, Novembers are even better. And now you have, this $6 billion a day worth of buybacks going on. There are some pieces here that are super positive that I think people need to keep their eye on. People are getting really wrapped up in who's going to win the election and how that's going to play out. There's no transfer of power until January, right? So, what's in place is already in place, at least for the next few months. There might be some expectations and some worries one way or another. It's kind of interesting to me that on both sides of the table, they've been able to convince themselves that the other side's going to ruin the economy. So there's a lot of concerns as far as that goes. But this is a big economy run by a lot of really great companies that are really good at dealing with different situations. Look at how these companies dealt with the pandemic, okay? Because that was a really big interruption worldwide, much more so than this election would be. And yet these companies continue to make money, continue to do well, and then ultimately actually ended up returning a really good return. So keep in mind the overall concept of how these companies go, and that earnings drive, the stock market. Stock market likes what it sees right now. We're still hanging up there, not that far from our all-time high. So today we got the monthly jobs report. Now, this is kind of amazing, actually. Only 12,000 jobs created in October.
Yeah, right? October was a rough month, but it was just a lot of one-time factors was affecting it.
Yeah. Yeah.
You had the two major hurricanes. Yep. You also have some major strikes with Boeing and stuff like that, and so those really affect the monthly jobs.
Yeah, it was interesting though. The expectation was someplace in the 70 to 100,000 jobs, so it's a fairly big miss. Even that expectation is quite low. I mean, last month we had 245,000 jobs on an expectation of 145,000, give or take, right? And so, to have an expectation drop down that much, obviously people were trying to factor in those two hurricanes and the strike, and maybe didn't get it quite right. Yet the market's up, almost 0.7% today, because again, this kind of fits into the narrative. You can't have an economy that's too hot, or you're going to bring back inflation and you're going to bring back increasing interest rates. And so that's a concern, so when you have a small jobs report that says, okay, yeah, we've had all this other good reporting, gross domestic product was good, earnings were good, maybe some softness needs to be in there to kind of keep that balance and keep us into that sort of soft landing, no landing zone instead of that reinflation zone, which is actually my biggest fear.
Yeah.
Recessions, we've been through those a lot of times. We haven't been through a reinflation scenario since the 60s and 70s, which is, what this Federal Reserve is worried about.
So it was a pretty brutal time.
It really was. It would have been. I mean, the Fed fund rate right now is 5% or what have you. It was at 19. At 1980 or 81, one of those two. Anyway, and that's when you hear your parents maybe or whoever talking about their mortgages at 14% and those kind of things. And so that's we don't want that. I mean, that's a horrible time frame. So at the moment, having a smaller number of jobs, I don't think is a terrible thing, especially when we look at the chart as a whole. Overall, the jobs are quite good. There's been lots of job creation as we've come back out of this pandemic, which I think is nice. And then lastly, this is just kind of amusing to me, but this is the CME Watch tool. This is the futures market and the basically betting on interest rate increases or decreases at the next meetings and beyond. So this one is the next meeting, November 7th. Okay, so that's next week. We're going to find out, they're cutting rates, not cutting rates, how much do they cut rates if they do, that kind of thing. It moved to 100% today. So yesterday it was at 94.8% that we would have a 1/4 point cut, and the rest was no cut, right? Yeah. With this jobs report, which comes out just before this meeting, it has now moved to 100% probability, at least as far as the market's concerned, that we would have a 1/4 point cut next week. So I don't know that I've ever seen 100%, all the way across like that, but it's had this really, it went from 0.5% at the very beginning. It was 56.7 is the highest I saw percent for a 2 rate cut, for 0.5 point.
Yeah.
And then that disappeared as the data came through and it was hotter and hotter and hotter. And, retail sales, all these different things, and inflation was somewhat under control, right? And so then it moved down to a 1/4 point and then maybe even some no point. And so anyway, we've settled on what I think is probably the most likely anyway. I would have been surprised. I was already surprised at the last 0.5 point cut. I would have been really surprised at 2 of them because, what are you doing that for?
Yeah, it's something breaking, basically.
Yeah, I mean, you'd have to wonder, actually, do they know about something that we don't know? And they do have access to, for example, inside of these banks and the regional banks and those types of things. And so, they can see some of the strain points that maybe we can't see, but, they're not perfect. Otherwise, they wouldn't have caused so many monstrous problems over the years, by raising rates too much or not lowering them fast enough, or in some cases not raising them fast enough, like the last inflationary thing that we had here in 2020, 2021. So anyway, that's what's going on. I still think this is a spectacular market. We won't actually be doing the show next week. So we won't be able to talk about, kind of what happened right after the election. But a lot of that takes time anyway, right? So we'll do it the week after that and, kind of see what's going on as far as that goes. I will do a summary on Friday. We'll just, I'll just do an informal one, not so much the show like this, but we'll talk about it then. But nonetheless, that's where we're at right now. I think personally, I'm still very excited about what's happening with the market altogether. It's had a really good run here in the last 12 months. And we'll spend some time at the next show talking about the Zweig breadth thrust indicator that triggered November 6th. This is an indicator that only triggered 18 times, and it was 100% accurate in terms of the market being higher 12 months later with an average rate of return of 23%. We're quite a bit above that right now, but we're not at November 6th, so we'll have to wait and see. So anyway, we'll talk about that at the next show just to kind of highlight what went on there. I know that a couple of the clients are really into that indicator. As it looks like it's going to keep its 100% track record, which is kind of cool. Okay, good. Let's thank you for joining me on the summary here, but let's talk about our next question.
So as an heir, do we have to split each asset evenly, or can we kind of mix and match? So kind of like if you have some assets that you can't really split, like let's say a house or a car, you can't really divide a house or a car. You can divide the interest, but you either you all keep it or you sell it and divide the proceeds.
Yeah, so over the years we've seen all kinds of situations. let's talk about the pros and cons of doing it both ways. So if you split everything equally, so like for example, you decide you and your two siblings are going to just keep mom's house or something, and all three of you go on the deed, all three of you own it. Maybe you rent it and you split the rent, or one of you lives there and pays the other two rent, or whatever. The advantage of splitting it evenly across the board and taking everything, you have X number of shares of the stock, divide it up into three and give each one, their piece. Is that it's very even, right? I mean, there's no doubts, there's no future doubts like, oh man, I wish I would have taken some of that stock instead of some of this house because that stock went nuts. Or I wish I would have taken some of that house instead of some of the stock, more of the stock, because the stock didn't do well. So if you have it evenly distributed, right, then there's no risk of that.
And it's really brutally simple when you do it that way.
Yes.
If you start to mix and match, like, so you have the option. Let's just take a car, for example. Let's say you have a vintage car, it's worth $50,000 and you have to split three ways. But if one person has like kind of that, vested interest, they really like this car, they want to keep it and like use this car, maybe they can use some other assets from, they have a trust with some stock, maybe they give up a portion of the stock. But you can do that for more of an emotional reason too.
Yeah, exactly right. And I think it just has to be communicated as well as possible what's going on, so that everybody feels like they're getting the right deal in the end.
Yeah.
So, for example, if that car is $50,000 and you have one other sibling, so half is 25, you care about it more than your sibling. Maybe you give up 25,000 of the stock portfolio if there is one, and take the whole car. And so. And if that doesn't work out, you'll have to deal with that. But as long as everybody's on the same page, and I think a lot of these things can go quite well. And actually, for all the TV shows about the infighting that happens about inheritances, and I've very, very rarely seen families really get into it. It happens, but it's much more common that things go fairly well.
Yeah, and just be open and clear with your communications. I think that's the most important part, is when you communicate these things, is that you basically say your intentions and you try and communicate in like an upfront and fair way.
Yeah, I think it's a good question. That you can, it doesn't have to be, because that's a question I think that comes up. Do we have to do everything a third, a third, a third if there's three beneficiaries? And the answer is no. You can settle on it, but there are pros and cons to both directions. All right. What's our next question?
What happens if a qualified charitable distribution check isn't cashed by the end of the year?
Okay, so this is if you have an IRA, and this is only if you are being required to do the minimum withdrawal, what they call an RMD. And so currently, that is a person that is 73 years or older, right? That's when it has to start. So let's say that you have to pull out $10,000 this year. You do have one option to avoid having that end up on your tax return, and that is to give it away, right? And so it's not true for somebody that is below RMD age, right? You can't do this. This is just for requirement of distributions. And so one of the things that happens is give the clients a checkbook, because they already give to charities anyway. They haven't been able to write them off because they're single deduction, the standard deduction is too high, and they're not really getting the write off. But they still give to the charities, because it's not just about the write off; it's about supporting these charities. And so, however, now they can use that same money that they've been giving those charities and try to keep some of, and not all of, that $10,000 off of that tax return. So if you write out a check to this charity, in order for it to be considered a distribution, and for this $10,000 mandatory withdrawal, the charity actually has to cash it. We've seen it happen a fair number of times where there's some mess up. Address is not quite right. Charity loses the check. We get involved in these things. So.
Small things happen, and like the check doesn't get cashed in time.
Right.
And so if it doesn't get cashed during this year and it gets cashed next year, let's say you wrote a check, you sent it beginning of January, but for some reason they cashed it or you sent it beginning of December and they cashed it in January, it wouldn't count for this year, it would count for next year's basically distribution.
Right. So I have to take 10,000 out. One of the charities, I send a check for 1,000. They don't cash it in 2024 like I hope they would. They cash it in 2025. I can still use that in 2025,
Yeah.
but now I'm going to have to take $1,000 out that I wasn't planning on taking out before the end of the year and put it on my tax return because they didn't cash it.
Yeah, because if you don't take it out, you have a penalty on your. If you don't take your RMDs, you have a 25% penalty on the missing distribution.
So in that case, if they didn't cash the check and then you didn't take out the 1,000, you're going to end up with a $250 penalty, right?
Yeah.
So I've never seen anybody have an RMD penalty in all my years of doing the business, but we do scramble around a lot at the end of the year to make sure that doesn't happen.
Yeah, and it could also depend on your custodian too. For Schwab, if the check is issued directly from Schwab, they'll count the distribution on the day of the check is issued rather than the day is cashed. So in theory, Schwab could issue a check on December 20th and it gets cashed on the 5th. It would still count for the current year.
Yeah, so if you're going to write checks, bottom line, do them early.
Yeah.
Don't wait until the end. So you can make sure that all these things, well, now I'd do them in January, honestly. I wouldn't play around. If you're going to give the money, give the money. Do it early. But, follow up if it is late. See if you can get the charity to make sure they're cashing the check and that kind of thing. And then if it gets really late and you still want to do it, you might be able to do it directly through the custodian. Like with Schwab, like he said, it's the 20th of December, and I still want to give away this 10,000. So you can go to Schwab, and they'll distribute the money instead of you writing out a check. They distribute it, and when it gets distributed, they count at that point on the 20th of December, let's say, for that year. There is one caveat, which is if they don't cash it within 90 days.
I think it's 90 days you get a warning, and then 6 months to the or something like that. But there's a period of time where they have to cash it, and if they don't cash it, the check is basically bounced and returns, and so the money goes back into the account. And that's when the issue with that is that there's no way to fix it.
Right. You're already past 2024. You're deep into 2025, and you haven't been able to get this darn charity. So it's enough time. I wouldn't think that's a real problem, to be honest. The charities love these checks. They'll cash them for you. Sometimes there's just some hiccup in the mail or the address or what have you. And so, it'll give you a chance to follow up. But there are two options: write a check. If you do so, I do so fairly early. If you're going to be really late, maybe let the custodian do it to make sure that you get that write-off. And then just if the custodian does do it, just make sure that check gets cashed within those windows.
Yeah.
Right. So it's still worthwhile. It's nice. It's nice. I mean, if you're already giving away 10,000 to charities, you're not getting to write it off. Now all of a sudden you're requiring minimum distribution age, and you're going to end up with 10,000 in your tax return that you don't really need and don't really want to be taxed on. And so you give that away through these different, avenues.
Yeah, and really this happened because the standard deduction kind of went up, and so less people were doing itemized, and because on the itemized, the deduction would be pretty much the same.
Yeah, exactly right. So if you are itemizing, then it might not matter as much, but we have a lot of clients because they don't have mortgage interest, a lot of times, right? Their house is paid off. We have a lot of clients that are doing these QCDs, and so it's something we're pretty familiar with. And if you have some questions about that, just contact us, and we'd be happy to kind of explain more. It does get a little bit confusing, but it's in the end, it's not that hard to understand after getting the right explanations. All right, what's our next question?
Who pays taxes on inheritance?
Who pays taxes on inheritance? Okay, so
there's a lot of different taxes that
I was just going to say that question isn't about inheritance tax. It could be.
So
they left out that word.
So there's estate tax. Right. There could be any taxes on the actual inheritance that you acquire, like property tax. There's also going to be income tax on any income that's generated from the inheritance. So there's a lot of different pieces.
Yeah, exactly. So, the estate pays those taxes. Let's start with the estate tax because that's the one that's kind of easy. Estate tax means I would call it an inheritance tax. Yeah. So right now, the exclusion that you can pass to your beneficiaries without any estate tax is $13.6 million. If you have a trust and set it up as an AB, you can actually double that, right? But if you're under 13.6 million, for example, as an inheritance, there won't be any estate tax or inheritance tax. And that keeps going up. I looked it up today. It's going to go up to 13.99, or basically 14 million next year in 2025.
Yeah, it depends on your state too. States could also have a little hand in this, but most
That's
don't.
true. Yeah, there are some state issues that are different in some cases. And so then, obviously you can have property taxes and things, that you have to deal with, because the estate doesn't just close overnight. So there's things going on. There's still bills coming in. The utility bills are coming in, and the last ones, maybe you're shutting it off. There's stuff that happens. The same thing with income tax that's coming into the estate. Obviously, pensions and Social Security should stop right away.
Yep.
However, if there is assets that are generating incomes, that's still there.
Yeah, if you have a rental property, it's still going to keep getting those rents.
Yeah, you hope so. I mean, that's what you want. Required minimum distribution, I believe that still has to be, if it hasn't been done.
If it hasn't been completed, you have to complete for the state.
It. So those are all income taxes, basically. They're going to end up on a tax return. So there's usually a final tax return that's prepared for the estate. The estate money pays those taxes if there's taxes owed. And that's why you kind of got to keep the estate open for a while, get everything kind of settled, so all the expenses are taken out of the estate, and what's left is now, not needing additional, ongoing, money from that. And then that's when the estate can close and all the assets can be distributed. Even in a trust scenario, sometimes it can take a little while just because there's a lot of steps, that need to be handled. But in terms of who pays the tax, the estate pays the tax, and the beneficiaries, it kind of depends. Maybe that's not completely true. Let's say that somebody passes away, and we step up the cost basis on the stock to current value. Let's just say it's $10, and by the time we're ready to distribute it, it's worth $11. So theoretically, if the estate sold it, there is a tax that the estate would have to pay. I would bet anything that it's probably better to just pass that share directly to the beneficiary and let them either just keep it.
And decide whether they want to distribute or not.
Right, or if they want to distribute it. There are some weird tax rules. Again, we're not tax CPAs, but there are a few a few different types of trusts that don't get the long-term capital gains tax treatment. So anyway, that's something to talk to your accountant about as far as that goes. But I mostly, in our case, we've dealt with a lot of these, is mostly share distributions and not liquidation and then cash distribution as much.
So, why is the market shaking off such a weak job reports? It's coming, it's coming so far under what expectation was, but the market's up today.
Yeah. So we had 245,000 jobs last month, and everybody's excited. This month's report comes out for last month at 12,000 jobs. That's a big difference. And obviously there are a few factors, and I think that's why the market's kind of shrugging it off, right? We had two big hurricanes and a pretty big strike. I've forgotten the number, but 30,000+ it was a strike at Boeing that are on strike. So, those factor into the jobs report as a net, growth or loss of jobs. I think the other part of it is sometimes in some environments, if you look since the rate cut of September 18th, almost all of the reports have come out hotter than expected. Gross domestic product was maybe exception. It was 2.8 instead of 3%. But, lots of good job numbers have come out. Lots of good retail sale numbers have come out. Inflation has been okay, right? And so this is okay to have something softer to offset some of the stuff that's a little bit
I think it's also
higher.
the market seeing that this jobs are kind of solidifies that there's going to be a quarter-point cut in their mind.
Yeah,
and so
exactly.
That's like, for them, that's a bigger factor because that is good for the market if there's a rate cut.
Yeah, it's good for earnings, right? And so, and that's good for the market in the end. So the cheaper money is, the more earnings grow. It can cause inflation, as we saw, in the 2020. But if inflation can stay stable here and we can still lower rates, boy, you're talking about a really good environment for the market. We're in the middle of a bull market. They normally run a heck of a lot longer than this one's run. So, it just adds more fuel to that fire. But having a little bit of weakness here is actually a good thing, I think. And that's why the market's up today and has been up all day. We'll see if it's the first, after the big drop yesterday, it's nice to see some bounce back.
Yeah.
Right. Although I wouldn't expect anything spectacular before the election, as the outcome is kind of decided too. So
Yeah.
it could be a little bit of a bumpy ride here for a while, but that's
Yeah,
okay.
the election's Tuesday, so it
Yeah.
won't be a much longer bumpy ride.
Yeah, might be a little while before they figure out who won, but
Yeah, that's true.
I think I can't remember. I was trying to think. I think in 2020, they finally made the declaration. Although everybody makes declarations, but anyway, I think it was more or less finalized after about a week, is what I remember. But people are going to do all kinds of different things in between times.
So I inherited this stock, and it has an emotional meaning to the family. Um, but the stock hasn't been doing well and is at a loss now. Should I ever consider selling it?
Okay, so we've got a couple of these situations in the practice where some previous generation accumulated some stock of a company, and it means something to the family. It's been driving the family's finances for a long time, and now lots of people own it, really, maybe.
Yeah.
So let's just say in this case, it's your dad worked at this company, and when your dad and mom passed away, now you as a beneficiary are looking at this stock, and it still has a meaning to you because it had a meaning to your parents, and you like to keep it, but it's at a loss, right? Especially with the finances of the firm continuing to do poorly. What do you do about that? Well, first of all, you could decide, yes, it's a sentimental holding, but do I need to hold all the shares? Right?
Yeah.
I have 9,000 shares. Does 1,000 shares still feel the same to me, or do I need to keep all the shares? There's nothing wrong with keeping all the shares. Right? Nothing. It's an inheritance, and sometimes it's more than the money, right? And so then, but there is another strategy, and I've used this several times with people in this situation. Towards the end of the year, we can look at their situation and say, hey, you're looking at right now, capital gains coming out of these accounts of about, say, 40,000 for the year.
Yeah.
So we could take that legacy stock and sell enough of it to get a $40,000 write-off.
So you wipe out the capital gains for
Yeah, and so I don't know, you just save 10, 15,000 in tax. You can then buy that same number of shares back in 31 days and avoid what's called the wash sale rule. However, you do have to realize that there's some risk there.
Yeah, you don't know what's going to happen in those
Right.
31 days. Is
Right.
the stock going to go up more?
Right.
And if it goes up more, are you going to wipe? Would you have actually made 15 or
Yeah,
whatever your tax savings would have been?
Yeah, we still do it because the tax savings are known and the other side is an unknown, and we usually will take the known over the unknown and take that risk. But what Ethan's saying is exactly right. If I do it, I'm going to save 15,000 in tax. But what happens if in that 31 days the stock goes up quite a bit? Now I'm buying that number of shares, and maybe I've lost 20,000 in gains that I could have had if I just would have stayed there. But that's a strategy to look at as a possibility. Whenever you have a stock that's at a loss, you can look at that as something to use against gains and kind of keep your taxes down.
And you can also evaluate the stock. A lot of times these stocks that are kind of at a loss tend to be down on their luck. So it could be just a continuation too, also. And so you may be able to buy as more or the same or shares at a cheaper price too.
Yeah, you think about over the years, some of these great, big, old companies that were just unbelievable in their heyday have had really big stumbles. And those stumbles can go on for a really long time, 3 to 10 years. However, because they're so big and they have such a big installed base, they do have a chance to turn around. And we have seen some of these, kind of turn around also. So if you're willing to, suffer through a potentially long period, you do have to be careful because not every company actually does survive. Not every company comes back and does well. But there is some hope, with a lot of these companies that they could come back. I can think of lots of them: Intel, GE, 3M. Apple's probably not quite. They haven't had that 90% drop.
But they were close to bank, or they were in bank.
Oh, that's true. I forgot about that back in that time frame. Yes, exactly right. Yeah, exactly right. Apple. Well, they're the biggest turnaround story ever. But not many people have Steve Jobs that they can bring back in and turn the company around. So Intel's a great example. I mean, a great old company. I mean, it was in the heyday. It was the chip stock. Period. You didn't really
Yeah,
need to buy anything else.
Yeah.
And now they're just stumbling along, having trouble. But
They
they're in the middle of a turnaround. They've had some good gains
Yeah,
this year.
actually today
Yeah.
they're up 7.8% on their earnings.
There we
So
go.
like,
Yep.
but the last year they're still down 53%,
Oh my goodness.
even after the 8% up today. So like,
Yeah.
it takes time for companies to turn around.
It does. But watch the story. I mean, if I'm looking at Intel, I'm thinking, okay, the U.S. is trying to onshore chip making. Intel's sitting in front of that. They've got a great history. Who else is out there that's really leading in the area of making chips on, American soil? And so, there's some pieces like that could really help as far as that goes. New CEO,
Yeah.
which, sometimes that doesn't help, but sometimes it can be Steve Jobs like, right? And they come along and really turn things around. So IBM's another one I think of from the past, really struggled for a long time. And then, they really came in and turned the company around and continued to increase earnings at a really nice rate, and that stock had a long run. It's not doing it now, but it was. So Cisco would be one too. I think about, right. I mean, they're still not quite back where they were, but they could be. So anyway, there's lots of them out there. All right, what's our next question?
So, what do you do with excess income? I've hit my savings goal for the year, and I'm kind of like on plan track for everything for all my retirement goals. But now I have some excess money.
That's a good problem to have.
Yeah.
That's what's better than a first world problem. I'm not sure,
Yeah.
but that's I've got too much income and I don't know what to do with it. It always comes down to there's three places that
Yeah,
you put it, right?
you can either spend your money, you can save it, or you can give it away.
Yeah.
Those are kind of the three ways you can handle excess money.
Yeah, and so then they're kind of like subcategories, right? So
Yeah.
if I'm going to spend it on what, right? If I'm going to save it, where?
Yeah.
If I'm going to give it away, who? So, and it doesn't have to be all in one either. It can be a mixture. As far as that goes, I mean, I always like to, divide up extra money or bonuses or whatever that might come my way into different categories, as far as that goes. So you could put a percent towards giving, a percent towards savings, and a percent towards, spending too.
Yeah, and this is the nice thing about when you have excess income, it really comes down to what do you want? What purpose do you want to serve for you? And so you have a lot of capabilities. You can do a lot of different things. Maybe you're ahead already on college saving for your kids, but maybe you want to give them a little bit additional money, so you could give it to your kids. There's a charity that you really like, but you haven't been able to give as much as you want. This is an opportunity for that too in the giving way. Or you can save it for a future goal, or you can upgrade your vacation that you have planned already. Maybe extra $1,000 for the budget, get a little bit nicer of a room or something like that. So there's different things you can do, but it's really about figuring out what you want.
Yeah, and the category of savings is kind of where we come in for the most part, and yeah, really that just has to do with timeline for the most part. So if you have a really short timeline, you got to do really safe things.
Yeah.
When you might need the money. If you've got a really long timeline, you should be in the stock market. Those are the two extremes, the bank or the stock market, and there's a whole bunch of things in between depending on your timeline for that money. And so, in the area of spending it, obviously, life experiences are a big one. My clients talk about that a lot. They're trying to, and a lot of times that revolves around travel for them, but they're trying to create life experiences. That's worth something more than the money they spend to them in that particular case. So yeah, it's a good question. There's a lot of things to think about to make sure that you're doing it correctly and that you're handling your money the way that you should be. That's for sure.
Yeah, a lot of times this excess income comes in the form of a bonus. Your company does well for the year, and they kind of share the wealth, and it's kind of a little unexpected.
Yeah, exactly right. That's those big lump sums that come, and this is kind of the time of the year that those might start coming too.
Yeah.
So. All right, well, that's our show today. Really thank everybody for coming so much. Just love doing this show. We won't be here next week, as I mentioned. We'll be here the week after. But I will try to do a summary for the stock market, on Friday. But nonetheless, if you have questions, you can send those questions in and we'll work on them for a couple of weeks. And you can email them to asktom@talkmoneywithtom.com. Happy to answer those questions. And then obviously, if you have more interest in these subjects, you might search our channel because we've covered so many questions. We've been doing this since April of 2021, so quite a while now. And so you can subscribe to the channel, hit the bell button when we put new stuff on there, so keep up with what we're creating in terms of content also. And then lastly, you can just meet with us if you want like custom answers to your custom issues. Our schedule's on our calendar, on our website. The website link is here on the channel. Book appointment button looks just like that. And schedule a 30-minute time to meet with Ethan and I, and we'll answer your questions directly that way. So anyway, thank you very much for coming today, and we will see you in a couple of weeks.